Hi there! Welcome back to another Lexawise exam prep video about definitions. Today, we're tackling some of the most important real estate terms you need to master. These aren't just exam terms, they're concepts you'll use throughout your career. So, take your time, jot down some notes, and try connecting these terms to real-world situations. And remember, you can find more vocabulary for free in our glossary. Link in the description below. Without further ado, let's get started.
Lexawise, Real Estate Exam Prep.
Here's how this works. I'll show you a term and pause to let you think of the definition. Then I'll reveal the definition and explain the concept. All right, let's start. Here's the first one. A valuation principle that says having nicer, more expensive homes nearby can increase the value of a property. What is this definition describing? Take a moment to think about it. Ready? Principle of progression. If you own a modest home surrounded by luxurious properties, your home's value might rise because of the surrounding neighborhood. This principle is key in understanding how location affects property valuation. It works the other way too. Less desirable properties can drag down values, so always consider the neighborhood. Got it? Great. Let's keep moving. Now, a tricky one. A situation in which a buyer takes title to property, but the existing loan stays in the name of the seller, so the seller is primarily liable for the loan. What does this one refer to? Subject to. This happens when the buyer doesn't refinance the loan. While it's convenient for the buyer, it puts the seller at financial risk if payments aren't made. For the exam, remember that the loan remains the seller's responsibility even though ownership transfers to the buyer. Next, number 3 on the list. Fannie Mae is the popular name for this federally chartered corporation, which creates a secondary market for existing mortgages. It does not loan money directly, but rather buys DVA, FHA, and conventional loans. This one is very important. Take a moment to think. The answer is Federal National Mortgage Association, FNMA. Fannie Mae plays a vital role in stabilizing the mortgage market. By purchasing loans from lenders, it frees up funds so lenders can issue more mortgages. Understanding how secondary markets work will help you grasp the bigger picture of real estate financing. Now, a deed in which the grantor warrants only against defects that occurred during their ownership. The grantor of such a deed does not provide a warranty or guarantee against any defects in clear title that existed before their ownership. What does this one refer to? Pause and think. Special warranty deed. This deed offers limited protection to the buyer. It guarantees no title issues during the current owner's period of ownership, but does not cover previous problems. For buyers, this means they might need title insurance to address any older claims. Next vocab definition: a fee that may be charged to a borrower who pays off a loan before it is due. Think for a moment. Prepayment penalty. Lenders impose this fee to compensate for lost interest. For example, if a borrower refinances early or pays off their mortgage in full, the lender might charge a penalty. It's an important term to know, especially for clients looking to pay off loans ahead of schedule. Next up, a contract for the sale of real estate under which the sale price is paid in periodic installments by the purchaser, who is in possession and holds equitable title, although actual title is retained by the seller until final payment. What do you think? Contract for deed. This arrangement allows buyers to occupy and use the property while making payments. It's often used when traditional financing isn't an option. However, because the seller keeps the title, there are risks for both parties. Let's move on to number 7 on the list. A form of ownership or taking title to property, which means each party owns the whole property and that ownership is not separate. In the event of the death of one party, the survivor owns the property in its entirety. Take a second. Joint tenancy. Joint tenancy includes the right of survivorship, which means the property automatically transfers to the remaining owner or owners without going through probate. This is a common ownership structure for spouses or business partners. Let's go to the next one. Land and appurtenances, including anything of a permanent nature such as structures, trees, minerals, and the interest, benefits, and inherent rights thereof. This one is easy. What does this definition refer to? Real property. Real property isn't just the land. It includes everything permanently attached to it. This term is key to understanding property rights and distinguishing between real and personal property. Here comes the next. Any property that is not real property. Can you tell what it is? Personal property. Personal property includes movable items like furniture, vehicles, and appliances. For example, a refrigerator could be personal property unless it's built into the home and considered a fixture. Did you get it right? Let's move on. We're now in the middle of this real estate terms list. Here is number 10. The highest price that a buyer, willing but not compelled to buy, would pay, and the lowest a seller, willing but not compelled to sell, would accept. Pause and think a little. Fair market value. Fair market value reflects what a property is truly worth in an open market. Appraisers and agents often use comparable sales to determine this value. It's critical for pricing properties accurately. Now, moving to the next interactive flashcard. Personal property that becomes real property when attached in a permanent manner to real estate. Take a moment. Fixture. If you bolt a chandelier into the ceiling, it becomes part of the home and is considered a fixture. Knowing whether something is a fixture or personal property is essential in real estate transactions to avoid disputes. Let's look at this one. The process used to deduct the cost of buying and improving a rental property. Take a second to think. Depreciation. Depreciation is a tax benefit for property owners. It accounts for wear and tear over time, reducing taxable income. However, it doesn't apply to land, which never depreciates. Here's a quick one. A written promise to repay a specified amount over a specified period of time. Think promissory note. This legal document outlines the terms of a loan, including the repayment schedule and interest rate. It's essentially the borrower's promise to the lender. On to the next one. The part of the purchase price of a property that the buyer pays in cash and does not finance with a mortgage. Think about it. Down payment. The down payment is the buyer's initial investment in the property. A larger down payment often means lower monthly payments and better loan terms. Next, the right of a government to take private property for public use upon payment of its fair market value. Think it over. Ready? Eminent domain. Eminent domain is used for public projects like highways or schools. While it compensates owners, it can be controversial. Knowing this term helps in understanding government powers. Got it? Let's move to the next term. An agreement in which one person makes a promise in exchange for a promise from a second person. The contract is binding on both parties to perform. For example, a broker's listing, which says, in consideration of the execution of the foregoing, the undersigned broker agrees to use diligence in procuring a purchaser. Which type of contract is it? Do you know? Take a moment. Bilateral contract. For example, a listing agreement binds the broker to market the property and the seller to pay a commission upon sale. Both parties have obligations to fulfill. Next is an agreement in which one person makes a promise, for example, an open listing. Pause and think a little. Unilateral contract. An open listing is a unilateral contract because only the seller makes a promise to pay if the broker finds a buyer. The broker isn't obligated to perform unless they choose to. Here comes the next, a very important one. An ordinance, regulation, or law that defines how property in specific geographic zones can be used. Ideally, they are set to promote public health and safety, but sometimes they are set for reasons of moral and general welfare. It is administered or overseen by the Planning Commission for all properties in the local area. Think carefully. Ready. Zoning. Zoning laws ensure properties are used in ways that benefit the community. For example, they prevent factories from being built in residential areas. One more? A right-of-way giving persons other than the owner access to or over a property. What do you think? Easement. Easements are common for utilities or shared driveways. They allow access without ownership, but they can sometimes lead to disputes. And finally, number 20. A legal claim against the property that must be paid off when the property is sold. Take a second. Lien. Liens secure debts like mortgages or unpaid taxes. Before selling, all liens must be resolved to transfer a clear title to the buyer. And that's it for today. Great job. Keep reviewing these terms and apply them to practice questions. We have a free practice test you can take anytime if you want to practice more. Check the description below. If this video helped, hit like, subscribe, and turn on notifications. Keep working hard, and I'll see you in the next video. Good luck.